In this video, I would like to formally introduce the formula to calculate CLV at the advanced level. This formula provides a framework that looks at customer lifetime over an infinite time horizon. It means companies should count all future revenue of their customers, assuming they will stay with the companies forever until they terminate the relationship. First of all, I want to introduce some terminologies. CAC is the average customer acquisition cost, which I have talked about in the first section. It is the average amount you spend on the acquisition campaign for every paid customer. Because it is a cash outflow, it has a negative sign here in the CLV calculation. And because it occurred at period 0, we don't need to do any discounting. Capital M is the average net cash flow, or referred commonly as contribution margin per customer per period. It is calculated as gross contribution minus retention cost. As you can see in the bottom of this slide, gross contribution is just sales minus cost of goods sold. Retention cost is how much you spend on retaining the customers. Previously, we have not considered retention cost because it may not occur if there's no effort on customer retention. However, customer retention is strongly recommended because it has been well known that it is much more expensive to acquire a new customer than retain an old customer. And generally speaking, the more the retention span, the higher the retention rate, which is a key component in CLV calculations. Letter R is retention rate, which is assumed here as a constant or an average retention rate. Letter D is discount rate. CLV over an infinite time horizon is calculated with several components. The first component is CAC, which has a negative sign in the formula. The second component is capital M, the average net cash flow, because it occurs at the initial time period 0, it is not discounted. The second component is capital M multiply retention rate and divided by 1 plus discount rate. This is what the company gets the present value at period 1. This component means the company will receive net cash flow M at end of period 1, but only R% of customers will be retained from period 0. And that amount needs to be discounted back 1 period to the present value. The fourth component deals with period 2, which has capital M multiply retention rate to the second power divided by 1 plus discount rate, also to the second power. It means only R percentage of customers who were retained at period 1 will contribute at period 2. And the net contribution needs to be discounted back 2 periods. Similarly, all future cash flow will follow the same pattern. Mathematically, the second to the last component together is called in the mathematical term infinite geometric series, which has a closed form solution. It is actually capital M multiply 1 plus D divided by 1 plus D minus R. How do we get that? For this course, you don't really need to know how the result is derived. You just need to know how to use the formula. Now let's step back and take a closer look at the last formula. It has 4 components: customer acquisition cost, CAC, contribution margin, capital M, retention rate, letter R, and discount rate, letter D. So if the business wants to increase customer lifetime value, there are a couple of ways to do that. First, spend less money on acquisition campaign, which will reduce CAC. Of course, it shouldn't come with the cost of acquiring less new customers. So then selecting the best acquisition channel becomes very important. Second, increase customers' contribution margin, which depends on how much customers spend and how much the business spends on retention. Business can use cross-sell or upsell to increase customer spending, and also optimize the spending on customer retention. These are all good tactics to increase contribution margin. Third, they can try to increase retention rate. This can be achieved by using targeted marketing, better product and service offerings, or excellent customer service. Remember, this CLV formula looks at customer lifetime over an infinite time horizon. However, in many cases, business may only want to calculate customer lifetime value over a finite time horizon, say 3 years. Such practice is quite common, as the customer value prediction might be very unreliable after a certain period because of the changes on economic situation, customer life stages changes, or competition level. So in the next video, let's apply the CLV formula we have learned in this video to the cupcake store example that we have talked about a lot in the previous sections, and see how CLV changes when the time value of money is taken into consideration. Okay, I will see you in the next video.